Hello everyone, welcome to lesson 3 of the cryptocurrency course. Now in this lesson, hopefully you guys have been paying attention to the prior lessons. I'm trying to do this in a way where it's in as much of a strategic order as possible. So I feel like one of the best things to do now we've covered the basics of support and resistance and trend line identification is to go a bit more depth on the candlesticks themselves and kind of go a bit further into that whole ideology I gave of the tug of war between the bulls and bears, because many people, we all use candlesticks, well, most of us do, but not many people really understand what's driving these candlesticks and what they physically mean. Now, this can obviously come in the form of candlestick formations and candlestick patterns, but I tend to not really look at those too much. Most of my trading is based more off key levels and trend lines and stuff. I don't really look too much into like pin bars or hanging mans and all that stuff. So I think the first thing to kind of go over is what is a candlestick. Now in this particular lesson, using just a BTC and XRP chart, it really doesn't matter, all candlesticks are pretty much the same. I have put all the bearish candles as blue and the bullish candles as green, purely for the sake of this lesson, so we can really go into depth on the bullish candles and the bearish candles. Now let's just go to BTC first, and we'll just have a look at some of these daily time frames over here and the candlesticks on the daily time frame. It doesn't really matter for this lesson too much what we look at, however we will break this down further into understanding why top-down analysis is so important as well. So from a first off basis, when it comes to the candlesticks here, when we look at a bullish candle, what does a candlestick even mean? What does it even represent? Now a good example would be this green candlestick here. You have the wick, which we'll get into in the following lesson. We would dedicate an entire lesson to understanding the wicks and their importance as well. But for now, let's just focus on this particular candle right here. Make that very faint in the background, just so you can kind of highlight it and see. The first thing to understand about a candlestick, a bullish candle, the open of that candle will be at the bottom of the candle. The close of that candle will be at the top of the candle. When it comes to a bearish candle, that means it opened at the top and it closed at the bottom. This is the close of the candle, this is the open. So to make this as clear as possible, marking this off from right here, and we'll put that to the front. This line here, let's make that blue or green. Let's just make that something. Let's just do that for now. So this exact line here, where this current candle body is situated, right here is where the candle opened. It opened at the trading price of around $18,388 approximately. And when this candle finally closed, we will mark this as red. That's at the front already, so we'll mark this as red. The candle opened at this particular price here at $18,388, and when it closed 24 hours later, it closed at $19,157 approximately. So because this is the daily time frame, no matter what time frame you were looking at, the candle bodies and closes are significant and represent the time frame you were looking at. So if you're looking at this candle now, let's just say here, it's obviously not going to reflect the daily candle, because the daily candle is a composition, as you can see over here, of many different candles within that candle that eventually lead to the daily candle closure. So this is in particular just one daily candle here. And what you can see is, we just get rid of this highlight and we now shift this over a little bit higher, we can see that once this candle opened and closed at this region here, the next daily candle then opens. And as you can see, it opens slightly higher than the prior candle before it. And again, just to make perfect sense here, obviously when a candle closes, the next candle 99% of the time, unless it's over the weekend or there's been a major gap or a lack of liquidity, the market will usually, and the candles will usually abide by what the prior candle closed as. So it closed here. This was on the 30th of November 2020, and when it closed at this particular level, the next candle then opens at this level. It's then up to this candle to either go lower and close below, or it could go higher and close up here and end up as a green candle. So the direction that candle closes upon its opening is what dictates a bullish or bearish candle. Very simply, if the candle closes higher than it opened, it is a bullish candle. If the candle closes lower than it opened, it is a bearish candle. So if we can go through the market, overall you can see, if we just mark that closure there for this candle, the next candle opened at the same line, just as this one did, but it closed higher 24 hours later, meaning it becomes a bullish candle. Now, although this is technically an indecisive candle, because it's green, you would still consider that a bullish candle to some extent. This candle then closed, the next candle opened, it shot all the way down. This is what leaves the wick, and we'll get to this in a second, but it closed lower than where it opened, meaning there is some kind of selling pressure causing this. So in the simplest term possible, you have to understand when people look at candles, they do not think about what may be driving this, what may have caused this, and what do these candlesticks actually mean. I've always been someone that personally likes to question everything in life. I've always been a very, not necessarily skeptical person, but I get interested and intrigued in how things work, why are they working that way, and why should they work in that way? Why is it happening in this particular manner? Is there a way this can be changed? Is there a meaning behind this? So one of the main things you should be doing is almost questioning the charts every time you look at them to understand if anything is happening for a reason. So if we have a look at this particular example here, we can see the candle opened here. Now, when it comes to the candle opening, there's not too much of a mystery behind the candle opening because it's opened where the prior candle closed, over here. So there's not too much. It's not like you see the candle open and think, wow, why did it open there? Because very simply, the other candle closed there. So the price, when the next candle opens, starts off from where the prior candle closure left off. However, when it comes to the closure of that candle, that's where things get interesting, because now there is some force that is causing whatever that selling pressure, manipulation, sell orders. There could be so many different factors going into why that candle closed there. It could be a Fibonacci, it could be anything, but something caused price to remain within this region. So a great example actually would be here. We opened there, we closed up there. So you, first of all, on the daily time frame, you would look at that and think, okay, something has caused this candle to close here. What you could then do is go to the 4-hour time frame, monitor this a bit more carefully. You would see the next 4-hour candle opened, it closed lower. So now you realize that actually the same force that stopped this candle from pushing further and closing at this level has now managed to push this candle further to close back lower. We then wait for the following 4-hour candle. The candle goes up again, but yet again, despite spiking through, the candle has failed to break this level here. So in the most simplistic terms possible, you can already start to gain an understanding, and this is where that top-down analysis comes in, of some kind of force in the market that is stopping this price from breaking above this particular level now. This is, in simple terms, how you would start to locate short setups in the market. We then go to the following 4-hour candle, which, bearing in mind this candle closed here, the next one opened slightly lower. It pushed up, it tapped this level precisely, and then it slammed the whole way down. So now you have a confirmation that this is a solid and solidified resistance level, and there is some force in the markets that have caused this candlestick to drop lower. Now this is, what is the price of this? 19,384. So if I just get a horizontal, plot this out, and put this same candle level here, so we mark that out. We now go back in time and we look to see, has this candle, or have candles prior to where we have just seen this potential reversal, have they suffered a similar fate when they've reached this level? And yes, they have. There's been many times before on the 4-hour here. If we go back, no, we haven't got any more. I've just realized that was all-time highs. So we can go back actually to 2017, however, it will take a bit of time, but let's go back anyway. Let's see how 2017 handled this particular area. So if we go back to 2017, which was of course the last real all-time highs of the cryptocurrency market for BTC, we can see when price drove up, bang, it taps this level, it came back down. It broke above, it didn't maintain for too long, it then closed at this level here. So what we would do is we would look at this particular level and understand that something has caused, yet again, this is combining the candlestick support and resistance levels with the support and resistance that we've covered. So we understand there is some force in the market at $19,550 approximately that has stopped the candles and price from breaching higher. So if we now just zoom out, go all the way back to the present day, let's have a look once again at what is going on here. Now if we go back to the same charts we were looking at before we went back to 2017 in the present day, you can see this level that we marked out and this level that we marked out, as you can see the rejections here. When price did manage to breach this level, there was another level above that managed to stop the candles from breaching. When it did breach the first time, it was very short term and very short lived. Price closed back below, and guess what? It went back to the same level again, tapped it, it spiked through, but it still closed below. The same happened here, the same happened here, it rejected there and it rejected there. So when it comes to understanding these candlesticks, you're first of all, when it comes to identifying potential regions for reversals, or even identifying the very basics of support and resistance, you need to be using, this is where that top-down analysis comes into play. If you use the 1 hour time frame, you can go a bit more in depth here and you can see candle failed to break, failed, broke above, held. Again, even when it broke through, it came back down and closed at this particular level. The next candle opened here, barely tapped it and dumped. When it came all the way back, the exact same happened again. If we go on the 1 hour time frame to this particular region here, we saw a breakthrough, it then came back and closed back below. It then fluctuated between, went through, went down, spiked, hit our second level, came back and closed exactly at this level again. The second candle opened here, obviously, closed, broke, then it becomes support. Pushed higher, came back down, pushed higher from this level, came back through, tapped again, and then we see the same cycle repeated. So in essence, understanding what is causing and what may be a potential level for these candlesticks to suffer a potential halt in movement is how you do the basics of top-down analysis as well. So this is what the main concept of top-down analysis is, as we covered in one of the first lessons. So if we were to look at this particular level here off the bat, 2 monthly candle closures, 2 monthly candle closures here as well. Well, not technically 2 closures. You had the bullish candle that closed here. The second candle went down below, came back through, tapped. The candle then closed back below, opened exactly at this level. Remember, it could have closed a lot lower as well, and then it bounced off this level. So you can see the significance of that particular level. When you go to the weekly, the exact same is happening time and time again. And it's all about just perfecting and refining those levels to find where the most possible and most accurate place and alignment is. In crypto, it will not always be perfect, but even leaving a few dollars or a few tens of dollars gap, that is why we plot zones as well. So an example of this would be, let's put this around there. So we've got the candle closure from the bearish candle close in there, and we've got the bullish momentum side over here as well. So if you were to plot a zone between these levels, we can turn the opacity up ever so slightly on this. You've got yourself yet again a very accurate range of where price is continuously finding support and resistance. So if you go to the daily, that's where you can get more accurate. You would have plotted those levels, and again, I think we even covered this particular one in the trend line and support and resistance breakout, because when we broke through, we came back, the same area that once stopped price from breaking through, once broken, came back to stop price breaking lower, and that would have been a beautiful short setup right there, something I do believe, if I recall, we captured. If not, it may have been a little bit higher, but around this region is a good example of exactly why you need to identify those candle body closures, not necessarily the wicks, the candle body closures, to give you as much clarity as possible on where price is going next. So that is the basics of the candlestick itself, like the bodies, which are a very important part of plotting support and resistance. But as you can see with cryptocurrency, when it comes to the wicks, they're not necessarily as accurate, and they do not necessarily provide the most accurate forms of support and resistance. That is why you need to use other factors and other confluences to identify potential areas where wicks can form, because the candle bodies themselves is where price is actually closing and opening. Where it spikes to does not necessarily matter, because that is usually large cases of manipulation. And when we get into this in the next lesson regarding wicks, we'll get more into understanding the manipulation side of the market as well. But focusing on those candle bodies where you see two of them in the same place in a very nice, especially when you see the bearish and the bullish candles closing like double tops over there. If it's just like this, for example, where they just keep going up and up and up, it doesn't provide too much information. But the minute you see a bullish candle that has then been halted by a bearish candle, you then get an understanding that there is some form of support and resistance in play. The same goes for a bearish candle that gets halted by a bullish candle in the following candle. This is why top down is crucial, because the daily, the weekly and the monthly provide much stronger data for what is going on in the market. But understanding the psychology itself, and again the wick as well, just so you know, is where it went up to and then still closed back down at this level. So at this point of time, just to use a live example of a candlestick here, this is the daily candle, has 8 hours left till it closes on XRP. It opened here because the prior candle closed there, the bearish candle opened there, it closed there, the next one opens here. This went all the way down throughout today to 50 cents. It has now come all the way back up to this level. So all the wick is, it is essentially a shadow, or it is the remainder, the footprint or the blueprint of where this candle once was before it finally closed. So just because it went down there doesn't matter, because it closed here. This is why sometimes you can see major reversals in the market. Many people may look at this wick and think this is a sign we could potentially continue going higher. But this doesn't matter, because the candle still remained, just to use a good example here, of around 70 cents. It went up to almost 80 cents, but the candle still closed below 70 cents. And then since then, there hasn't been a return to 70 cents just yet. So you're getting a rough idea that this was a false manipulative move, and price then continuously remained more in a bearish trend. So that's that overall. But when it comes to, and when I say the psychology of a candlestick, what I mean is, what is driving these candlesticks? You know, we all look at candlesticks, we all again look for the patterns, the formations, all of that stuff, but we don't truly ever stop and think, what could be causing this movement on a particular day? What is the driving force behind everything we see on these charts? No matter what chart we look at and on what time frame we look at, there is a force causing these movements. Now in crypto in particular, we know it's a wild west. It's very heavily manipulated. We do not have the same liquidity in the daily trillions of turnover that the forex market has, which means with a lack of liquidity it's more vulnerable to manipulation. So we need to understand driving forces. The same does apply to forex, however, but in its most simplistic form and in a nutshell, it is human emotion. When you look at candlesticks, you are seeing the remainder and the blueprints of human emotion on your screen. This is nothing more than testosterone, anger, greed, happiness, euphoria, every emotion or every emotional feeling that can cause a reaction or a decision, especially irrational decision making. For the retail traders, the majority of the emotions that are left behind in the chart are irrational decision making processes. But when it comes to the institutions, when it comes to banks, when it comes to brokers, when it comes to hedge funds and those who understand, whether that's insider trading or they simply have the capital to manipulate the market, that is a rational decision, because they are using certain price points. They are using buy limits and sell limits. They very rarely use market executions. They are setting orders and accumulating orders at certain price points to trigger catalytic movements in the market. So again, just to reflect on this and just to go over this once more, what you see when you are looking at a chart is not necessarily just the price movement of the particular pair you're looking at. You are looking at human emotions printed out in the form of multicolored candlesticks, or potentially just single colored candlesticks if you do things like myself. And hopefully now you can understand, when this comes into a future lesson, why I only use single color candlesticks, because it eradicates the emotion. in essence, this is another case of inception because not only are human emotions causing these movements and then leaving behind candle body closures that are a reflection of human emotions, but then you are also emotionally impacted by what you are seeing left behind by those emotional decisions, if that makes sense. So essentially, throughout the day, millions of human emotions are combined and compact within these candlesticks. For the daily candlestick, a single 24 hours worth of millions of people's different emotional decisions and decision-making processes and actions have been solidified into a single candlestick. When you start to look further over time, the same people who are watching these charts are then emotionally impacted by this, especially when you're using different colors, because a bearish candle can emotionally affect you in what you're going to do next on a trade. A bullish candle can affect you on what you're going to do next in a trade. Hence why I stick to one candlestick color. Although green is technically a bullish candlestick color, I stick to one because that takes another hurdle out of my trading game plan. Very powerful stuff. But when it comes to those human emotions again as well, just to go into a bit more depth on this. So when I say euphoria, emotion, greed, essentially the footprints that are laid behind every single day. If we go to the 1 minute time frame, this is probably the best way to look at this. Maybe even on a forex pair this could be more accurate, but for now we'll leave it on here. As you can see, this movement here, much more volatile, gappy, choppy. This 1 minute chart, and this is why we do not look at 1 minute charts necessarily. Even when it comes to entries, it's very rare I would look at something like this. This is what erratic chart and erratic human behavior looks like. When you put focus on these particular 1 minute time frames, it gives you a bit more clarity into the irrational decision making of not only the retail trader, but the irrational decision making that has been caused by the institutional trader or the large hedge fund trader. All of these movements here are simply human emotions fluctuating back and forth, impulse decisions reacting off all kinds of different external factors, whether that is a level of support, whether that is a level of resistance, whether that is another level of resistance there. And this is why I say do not analyze too much on lower time frames, because when you're trying to analyze, again, it did reject, but look, if you're trying to analyze, even though these are all good levels, you are trying to almost understand millions of people's different emotional decisions every single minute. And unfortunately, due to the erratic nature of the market participants, the retail trader, and overall humans tend to not be very good at controlling their emotional and thought process and their decision making processes. It takes a lot of training, and most people never actually go to the extent to do that. So you can see in this 1 minute candle, we've seen a spike, we've seen a spike down. This candle's now shooting down. It's just chaos. So higher time frames are very important when it comes to understanding candlestick psychology, because you can filter out all of this mess, absolutely everything. Let's go to, it's the 9th of December, 16th here. So if we go to the 9th of December over here, it's 1 minute time frame. So from around this level here, around this region here where the candle or the day started today. Today is Wednesday, I believe. I've lost track of time. So when Wednesday first started, you could look at this 1 minute time frame, and within this 1 minute time frame, this is what has been occurring throughout the entire day. And throughout that entire day, a lot has potentially happened on this chart. This is almost like a heartbeat monitor. If you drink too much Red Bull or too much coffee, your heart rate will start to look like this. And that is pretty much what is going on in the charts on a continuous, ongoing 24/7 basis. Go to the 4 hour time frame. Now we can go to the 9th here, where it started. Now suddenly we can filter out all of that noise we were just looking at from this particular point here, and we can now get all of that data and compress it into much cleaner, easier to read, digestible formats. This is, I guess the best way to explain this is, imagine what we just saw on the 1 minute chart was a folder on your computer, and it was hundreds of different images and video clips and GIFs and all kinds of crazy stuff. You've now taken each piece of data that is based on a particular time frame, so everything you've done from midnight till 4 a.m. as an example, you have put into one folder and you've compressed that folder. That folder you have now renamed to bearish. The next folder, you have done the exact same thing for the next 4-hour interval. You've compressed it and you've named it bullish. The same goes here, the same goes here. You are compacting that data and compressing it on the higher time frames to instead understand in a much more easier manner what is within that folder, without actually having to open that folder and go too much depth into it, or without having to go here and shift through each file one by one by one. So again, a good example from around here up to here. Instead of going through that file and trying to find that main piece of information you needed, which could have just been one particular file that would have given you all you needed, you would have had to have gone through every single one over here, hundreds, just going through, trying to find that one video or GIF, for example. Go to the daily, and you can then compress that folder into another potential folder. And now you can compress all of that together, and you can call it indecisive as a good example. So I hope that is a very simple way of understanding that. I'm just kind of expressing, I always, as I said with the house idea, and you know, putting the support and resistance into particular categories like the ceiling and the floor, and I feel like by kind of understanding that these are compact compressed folders, I feel like it could really help you understand the charts a bit more and really understand what's going on. So that's probably the best way to understand this, because every single minute of the day there is someone buying and selling, and this is how I said it's a game of tug of war. So let's just say you are here and you start buying. If you see this candle and you're a seller, irrationally and emotionally as a human, many people do not want to change bias. Many people do not want to admit they're wrong. And this is why I say the markets are driven by greed. The markets are driven by that Wall Street, that cliche Wall Street testosterone fueled kind of, it's just an open battlefield of bulls and bears. And when I say a battlefield of bulls and bears, nobody likes to be wrong, which means nobody wants to lose. But of course, for there to be a winner, there must be a loser. For there to be a loser, there must be a winner. So you are watching from a very far back perspective the remainder of a battlefield, as I said. So imagine you are sitting back at your computer screen now, and this chart in front of you is a field far out in front of you. And far out in front of you is this battlefield between human beings playing tug of war, fighting, all kinds of crazy stuff going on. And as each day progresses, the human bodies have remained left on the field. So you can then observe where those bodies are, what they have done, where they have gone. It's almost like a trail of imagining where that army has gone, where have they gone to, who have they left behind. And when you start to pick up on these patterns and you monitor and you understand, well, actually, why did this drop so much? Why did this then stop at this particular level, and why did it come higher? When you then go to innovation gradient and you get rid of the psychological aspect of bullish and bearish candles, it then, once you, again, you need to understand the candles first, and obviously getting used to it. Using the bullish and bearish candles is of course crucial, otherwise you may not be able to tell which one is bullish or bearish, or if it is an open or close. But with a trained eye, you will start to pick up on this more and more. So once you've now stripped away that side of everything, you can put more attention on refining and understanding what these candles are doing, and then instead looking at the candle body closures. And that's why the higher time frames are so important. So if you go to the monthly, I can now look back and just say, do you know what? Who cares what happened within every 5 minutes within this particular candle? I just want to know what happened for that entire day. It's like checking the weather, for example. Probably not a good example, but checking the weather. I want to know predominantly how my whole day of weather is going to be. I do not want to know, even though most weather apps do this, I would much rather know that it's pretty much going to be sunny that day to give me a bit more understanding on what's going on that day. I do not want to know that it's going to rain at 6 a.m, snow after that an hour later, it's going to be windy, there's going to be a tsunami. It may be informative, but sometimes it doesn't need to, you do not need to know that much information. And the more you look from a further back perspective, the more you're going to see. This is a common aspect of life in any forms of life. The further back you look, the more you get to see. So let's just look at this as an example. There was a wick there. We've now got a double top on the monthly. So if we look at these two candles here, and we go back to marking this out in blue for the sake of this video, we have seen the candle opened here. it drove all the way up, and this next candle, which obviously closed in 22 days, so we cannot really say much yet, has now pushed lower. So we look at this on the weekly and we think, hold on a minute, what has caused this candle to stop here after going from $13,800 to $19,700? What has caused this to stop dead in its tracks? And then what has caused this to then plummet all the way down from $19,700, ignoring the wicks, and coming all the way down to around $17,600? Something has caused that. And that's where you then drop down again. You say, okay, there is something clearly going on here. Because when you drop a bit lower, something stopped these candle bodies from now breaching higher. Again, significant movement upwards. We then push down on the weekly, and then guess what? That then became the support floor because it opened and it maintained above. It closed, it's come back down, it's now maintaining around this region. So price is now compacted between a particular range. If you go to the daily, you can now see in even more detail that this is a crucial region where price is continuously bouncing back and forth from. All we've done is gone from the main two folders, this is the master folder, and everything is within this particular folder. We uncompress this folder and open up the 3 folders that are within this one, and we monitor it, we observe it, and then from there we go down to the daily. Once we go to the daily, we understand further. Okay, price has come in, it's rejected, it's gone up, it's gone through, it's come back and closed exactly at this level. It's then broken through, come back down, rejected, rejected. Now we look at this current candle. It's come back down, but it still hasn't broken back below. So we can understand that within these folders, there are more folders. And if we then go to the next 4-hour folder, we can see there was a break, but it's now come back above. So what we can potentially look at is price going back towards this region here. Hopefully this has made a bit of sense. I've really tried to explain this in a creative way and an easily understandable manner, so you can understand that you're not just looking at, you need to look into it deeper. You need to understand it's not just candlesticks. Of course it's just candlesticks, but there is something that is causing those candlesticks. There are institutions that are trying to trigger and manipulate price in those certain directions. When they then do that, there's a chain reaction and a catalyst effect, which is then causing the people who do not have as much significant influence in the market to then jump on board. And this is why, as retail traders, it is our job to either identify what the potential market makers are going to do next by understanding the levels they are halting the price at or driving price to before causing a reversal. When we then look to piggyback off those moves, we want to do that in accordance with the signs that these market makers have left behind, because that's all it is. It's a blueprint of what people who control the market are doing, but also these candles are then aided further by the retail traders who jump on afterwards. So all you have to do is kind of look from the higher time frame, be very patient, and understand that these particular institutions or these Wall Street traders or the banks, the government, whoever is trading these assets, CME futures traders as well, why are they driving price to this level, and then why does it reverse down from there? These are literally the most simplistic telltale signs I can give you, and they will always come back to repeat themselves time and time again. If we drag this lower, where we had 3 candles maintain above this region, when it did break through, where did that candle come all the way back down to there? It then closed above here. So we can now predict very easily in the future, when a candle does come down very soon, it's very likely going to tap this level to cause some kind of ricochet effect back up, and then potentially drop lower as well. In this particular instance, we do not know what's going to play out yet, of course, but we can give ourselves higher probabilities by understanding what's driving these candles, and understanding that if we too become another statistic that causes the movements of these candles, and this is why they say 95 or 99% of retail traders lose, because they are contributing to these candles. They are causing these candles to go the way they are without meaning to actually do so, because they are basing their decisions off irrationality and they are becoming victims of market manipulation. They too are causing these movements in the market, and instead of being able to capture these movements, they are getting caught within these movements, and often in the wrong direction. So again, I hope this has made sense. I hope this has been a fairly intriguing topic for you all as well. We're going to be going into even more depth in the next lesson on wicks and combining this all together. But hopefully you can see how every lesson I'm trying to tie in one piece of each lesson to the future one as well. So we can keep it seamless, we can keep it flowing, and you can see how nicely this is all combining now with the understanding of support and resistance and trends as well. When you consider those higher highs and higher lows using that same principle, bang, candle body closures, bang. And again, it progressively gets higher in a trending market as well. The same goes for a descending market. So again, hope that has helped. Hope you guys have enjoyed. I'm looking forward to doing lesson 4, which will be based around the wicks and understanding market manipulation as well. And don't forget to subscribe. I hope you guys are enjoying the Innovation Markets app as well. We've had a phenomenal kickstart to the week. We've had some good trades thrown in there. We've got some great content coming for you all. And I cannot wait for the future of Innovation Markets. And I hope you guys have all enjoyed. Have a great day, and I'll see you guys very soon.